Inflation is hot. The 10-year notes are probably going to 6%, which puts mortgage rates at about 10% probably. Housing's going to collapse. We haven't even scratched the surface of what I think the collapse is going to be.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for February 21st through February 28th, 2023 while supplies last. This week we featured 2022 Silver Maples at $3.40 over spot. Silver Maples were the first silver sovereign coins to be minted at 4/9 fine purity and remain one of the most in-demand and recognized coins today. They come 25 to a tube, 500 to a box, and are available at the lowest premium we've seen in more than a year, at just $3.40 over spot. Canadian maples are also IRA eligible, and if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. To order this special or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is Todd Bubba Horwitz from Bubba Trading. Thank you so much for joining us today, Bubba.
Elijah, it's always great to be with you. A lot of good topics, a lot of good things to talk about today.
Well, it's great to have you today. One of the things I did want to discuss is we just saw, we're recording this on Friday, we just saw the PCE come out. This is the Fed's preferred measure of inflation. It's hotter than expected. How is this impacting the markets today?
Well, the markets are getting hammered. And of course, we know from the Fed minutes the other day that there's a lot more hawks in the Fed than there is doves. And that rates are not going to stop going up. And you know, this is kind of a game that they're playing. And I think this is leading into the digital currency world. But inflation is not under control. We don't have people working. We're more in danger of stagflation right now, which would be obviously the worst. High prices and nobody working, because the jobs numbers, which we'll see next Friday, are going to be garbage as well, because the jobs that we're seeing are part-time employment, not full-time employment. So you have a hot inflation number, which is still well understated. And I can tell you that I don't go grocery shopping a lot, but when I'm in Vegas myself, which I have been, my bill is 40% higher over the last 6 months. So you can do that, and that's buying the same exact products. So inflation is hot. The 10-year notes are probably going to 6%, which puts mortgage rates at about 10% probably.
That would be extreme rates for mortgages there. I did want to get your perspective on that, because it seems like a lot of people are looking at rates right now and saying, well, how could they go higher from here? The housing market has already taken a dip. It's a fantastic time to buy, but you don't see a positive outlook for the short term for housing, it seems like.
No, this is a terrible time to buy if you're going to buy housing. I mean, housing's going to collapse. We haven't even scratched the surface of what I think the collapse is going to be. This is going to be, in my opinion, a repeat of 2008. Okay, now, you know, 6 months from now, a year from now, you might have the greatest values ever once again. Because remember, housing value is no longer determined by the house itself. Housing value is determined by the cost of money. And the cost of money is rising, so housing is falling. In the meantime, a house you could have bought 6 months ago and you're going to pay X for per month, you're going to pay X for less now, because and the people aren't selling as quickly because, of course, they think their house is worth more because of what it was worth 6 months ago. It's a money game, and it's a dollar game now, not a true market game. Because, you know, when I had my first mortgage, it was 13%. So I think what you have to look for here is housing is going to fall, and I think you'll probably see 20-30% lower prices than they are now. And the key is save your cash and be ready to pay for it without having to borrow, because you'll get a heck of a value.
I think that is the best way to play it here. I mean, if people have the funds, probably waiting for the rates to spike and then purchasing, it sounds like, because at that time, taking out a mortgage probably wouldn't be really affordable for a lot of people.
Exactly. I mean, again, you have to remember what the value is. And again, money changes. The higher interest rates, actually the lower value of housing, just because it's purely, you know, we're a by the month society. How much is it by the month compared to my paycheck? That's what we're watching. And I expect to see housing. I mean, you know, it tipped off here in Vegas not that long ago, before rates even started rising. You needed to qualify for a 7% mortgage. Now you need to qualify for a 9% mortgage. And already the new construction, because it was so hot, is slowing. And now they're making deals on houses that haven't been built yet. That tells you that there's a big problem and that the banks are in deep water once again, even though they keep promising us and telling us that they pass every stress test with no problem.
Now, what are the ramifications of this in the banking system, as you're mentioning? Because obviously in 2008, it was very disastrous. There had to be those bailouts and everything. So what do you expect this time?
The same. I think that the banks are too over leveraged. I think that, during COVID, they gave them the green light to go well over the mandate of 10-1 in lending. And again, the scam of the Federal Reserve and the scam of banking is that, the banks borrow from the Federal Reserve. That's the lending rate. And of course, they can take that loan, which is actually a liability, and then turn it into an asset and then lend out 10-1. So they're actually paying for that loan that they took through the money that they're lending out. It's a real scam game that they play, and that is allowed to be played by the Federal Reserve because, of course, they have the American taxpayer to bail them out once they go bust again.
And how do you see this impacting the other markets if housing does take a crash like we saw in 2008 or even worse than that?
Well, listen, I think the last time we talked, I told you I thought equities were going down 50 to 70%. Okay, I have not changed my opinion. We're up a little bit for the year now, but I'm not surprised. I mean, we had a down year last year. You got always some early buying in the year. I think we're now seeing we're breaking down some very key levels right now. And if they hold, I think that we're going to be 50 to 70%. I have not changed my point of view there whatsoever.
And for timing on this, do you expect that this year or in the next couple of years is what you're saying?
Yeah, I cannot time it. I wish I could tell you a timing. Now, again, for me personally, I'm always long, no matter what I say, and I'm always hedged. So it doesn't really matter. But my trading positions are all short. And I think we're starting right now. The breakdown through 4,000 S&P was a pretty big number. And I think we'll probably next stop, we'll test 3,900. But I think you're going much, much lower. Those are going to be big rallies. Bear market rallies are the most vicious that you can get. They look the best. And of course, those are really great selling opportunities.
And we're seeing today also a sell-off. It seems like in everything, I mean, precious metals as well. Do you anticipate this will continue, at least initially, with the sell-off in the stock market?
The stock market is going to continue to sell off, I believe. The metals, I think what happened is they got a little bit too far ahead of themselves. We go back about 3 weeks from today. Okay, you saw that gold had made a near-term high and then just collapsed. And I think what happened is the buyers got too aggressive and there was nobody left to buy. So now you're having some pressure going on. And, I do think that gold is going to find a bottom here somewhere. And I think it's going to go a lot higher. I do think that gold will make new highs this year. So I think that gold will find its level and its bottom and make some highs. And of course, we're having a little bit of a rally in the dollar right now. And not that I'm a big fan. I don't like to really correlate the assets, although they are correlated. Short-term correlations don't mean anything. I think gold will probably find a bottom, maybe as low as 1,800, a little bit lower. And then it would look to go higher. But certainly, if you're a physical buyer, as I am, I don't care what I pay for it. I know it's going a lot higher over time.
It does seem like, at least recently, we have seen an extremely, the dollar index has been inversely correlated with gold for whatever reason recently. What is your outlook for the dollar at this point?
Well, I think the dollar is going higher right now as it still stands as a reserve currency, and the troubles around the globe and the finagling with the fiat currency system itself is so fraudulent because there's nothing backing any currency. It's all central bank chit chat, right? So it's your turn to get hammered. So no matter what the number of the currency is, what happens is it's still worth less, right? So, that's part of the inflation. That's part of the taxation without representation. They do it through the dollar. They do it through other asset classes. So Americans actually have to pay more money, even though it seems like they're making more money, which they're really not.
And can you share with the viewers your perspective on how the average person can protect themselves against inflation? Because it seems like we're seeing a lot of things at the same time, and we've discussed this before, but with the housing market, if the value, for example, of their home is going to be going down, but they're going to be having to pay more for their groceries and all the living expenses, it doesn't seem like a pleasant road ahead if people just don't do anything to prepare.
It's not a present road ahead. I think you do have to stay invested in the market, though, if you can afford to. I mean, first of all, the money invested in the stock market should be money that you can afford. Okay, it should not be your emergency spending. It should not be your mortgage or your car payment. It has to be money that you can afford to have in that market. Okay, and then you can use derivatives to hedge that so that you limit your risk down to a small percentage versus people buy and then they get too nervous and they start selling. You don't want to sell. Remember, it is time in the market, not timing the market. So what you want to do is figure out how to use derivatives or options of what I use. I mean, I have a whole program that does it automatically for me. So it trades constantly. When markets drop X amount of percent, it rolls down the hedge and buys more. That's what I think that people need to learn how to do so that they can stay in the market and protect themselves and not have the fear of it going to zero.
Now, there are arguments out there that the stock market is so overvalued right now that it'll take very, very long for the stock market to make new highs. But it sounds like you're still a believer of hold for the long-term mentality.
Well, listen, all I can use is the evidence that I have. And the evidence that I have is for 150 years, the markets have gone up 8.5% year over year on average. So I can't ask for more proof than that. From the history of time, we've had an increase of 8.5% year over year, not every year. So, are we going out of business? The only quirk that would come into the markets that would change, that would make this time different, is if we become a socialist nation, which we're headed that way, but we're not there yet. Okay. You destroy capitalism, you're destroying this country. That's, this administration is doing a hell of a job trying to do that. And that's one of the things that we have a problem with. But based on history, I can only base that 8.5% has been the number no matter what, through 87, through 2001, to 2008. We're still on the same average. In fact, since 1950, the average gain is 10% year over year.
And do you suggest to people maybe purchasing like ETFs of the indexes, or what kind of stocks are you looking at right now?
Well, you can be a stock picker. I think that's fine if you like some companies that you find value in, but you want to make sure that those companies have value, that you believe they're going to be in business 10 or 20 years from now. Or you can use, the indexes, which is a safer bet. They do pay some small dividends, and they are a much bigger blend. The indexes are nothing more than mutual funds that are, that trade openly, that you don't have to wait for fills and do your thing. They're very liquid. So I do both, but if you can find a value stock that you like an Apple, for example, at a reasonable price, hey, what's wrong with that? It's a company that makes money. They're not going anywhere. Verizon, any of those types of companies that have been around forever and will be around forever, most likely, is what you want to have. You want to have a company that's, you don't want these speculative companies like a Beyond Meats or something like that doesn't make any money. Make sure the company at least makes money and can support itself.
And then back to housing here, for those people who own their house outright or maybe have a fixed rate mortgage at the moment, do you think long term they're going to be okay, or do you suggest possibly looking to sell at this moment? Because it sounds like
I wouldn't sell my house now. I mean, the play to make, and I think you and I talked about it months ago, was to take your money out if you had equity in there and take it out at 2 and 3%. Okay, because you can put that in the market and get basically 8%, right? So you're actually doing an arbitrage. I would not borrow on my house at these rates, nor would I sell my house at these rates. I think that you're selling into a hole and you're selling into a panic. I mean, if you're planning on moving, then it's a wash, right? You're selling it at a discount, you're buying at a discount. But if you've got a low rate mortgage, which most should, okay, that's not one of those adjustable rate fancy deals, okay, that's flat, then I wouldn't, if I'm at a low rate, I'm not doing anything. I'm standing pat. I don't want to borrow new money at higher rates. One
of the things that a lot of people say is that staying out of debt is very important because we don't really know the curveballs that could hit people. The average American is being squeezed right now and the cost of living is going up. So how is being in debt a prudent decision right now? It seems like for people who have a mortgage.
You never want to be in debt unless you have to be. Obviously, most people don't have $300,000 or $400,000 or $500,000 laying around to go out and buy a house. Okay, you want to avoid debt at all costs, especially credit card debt. And in fact, my son, who's an advisor, when people come to him to open up an account, he says, "Do you have any credit card debt? If you do, before you open an account with me, you need to pay off that credit card debt because you cannot make the yield that you're paying for that credit card." So you have to measure your own personal life, and I guess if you're high debt and credit card, then you can invest all you want. You're never going to overcome that interest rate that they charge on credit cards. So it depends on where your debt lies. But always satisfy debt first before investing new money somewhere else, because getting rid of that juice payment and that payment is more important. Just like an investment, you're saving money in the long run.
And as you mentioned before, really looking at the market and when people are putting money in the market, thinking of that money as, money that they can afford, and so I think kind of staying within your means is definitely important in this case.
100%. You have to live with the money that you have. Again, too many people, and if you look at credit card debt, you can't look at the number of dollars because, of course, they're inflationary. But the number of people that are maxed out on their credit cards has never been this high. Okay. And you're going to be paying 24, 23, 26, 28% to pay that money back, which is almost impossible to ever pay it back. So again, you must satisfy your debt first before you start investing new money and still whilst trying to satisfy the old debt.
Fantastic. Well, Todd, we really appreciate your time today. Any last thoughts before we let you go, and where can people find you online?
First of all, just be careful. Again, remember, investing is a long-term game. Trading is a short-term game. So if you're investing for your future, you have to be able to stay in the market. You want to be able to buy things that you know that are going to be in business. Don't let the ebbs and flows or the ups and downs of a market. It really will create opportunity for you, just like in gold and silver. Buy them when they're falling down because they're going to come back at some point. They're hard assets. They have real value. And if you're getting a hold of me, Bubba at BubbaTrading.com. You can email me anytime or go to my website and you can join me on my Monday Night Call if you email me.
Todd Bubba Horwitz, once again, thank you so much for your time and God bless.
Elijah, thanks so much. Always great to be with you.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we can let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Kaiser, my brother Elijah, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.